Guys, this is Stock Retail coming back to you. I'm going to do a recorded video today. Got a few questions, or a consistent question, I should say. Just a couple people still interested to look through, I don't know, our profit drivers, our forecasts, maybe the future flow of the AMC business, and kind of how that ties to the value of our stock. I know that's always just of interest to all of us. And because I got asked by a few people, I just thought, I'd love to do this live. Would have been fun, but you guys have seen the lives have been pretty glitchy. So I'm going to treat this a little bit like a live in that I will just kind of do this very informally. I did not prepare, PowerPoint and all that stuff this time, but it'll let you also, I think it might be good because if anybody's curious to be able to put their own brain to this and think through where perhaps you disagree with me also, I can give you the ways that I'm looking at this and give you some of the assumptions and all that so you can kind of pick at it. So I'm literally just going to kind of go through the spreadsheet today. It'll feel a bit more like a live. And then, you just, all you'll miss is, having a fun chat with some of your friends and or a few shills who like to drop into the chat. So let me, without further ado, jump over to the spreadsheet. So I'm just going to kind of, like I said, I'm going to treat this very informally, but I'll show you the build a little bit of how I get to numbers, and I'll give the bottom line numbers. And then by the end, what I'm going to do is basically plug in at a few price to earnings assumptions, what maybe the stock might be worth. And we'll look at that on a few timelines. Made a very simple one here, but I'll show you another one I have that has like a rolling 4 quarters as well. So at any point in time, forgetting any manipulation, any market sentiment, just straight up math based. And that's why, I've gotten more comfortable being willing to do this because, certainly people price anchor you. And so I've always been cautious about, I don't like giving any prices because what I don't ever want to do is have, have me kind of making people think about something smaller than perhaps we might be able to squeeze to and that kind of stuff. So there's still, discussion about how many shares are borrowed, and various other metrics of what might, factor into a squeeze. So I'm not talking about that. I'm just going to talk math today. But it all starts with, I've shown you guys basically all kinds of stuff about how movie by movie. So why don't I make this bigger today? Click on the right plus button. For those of you who've been around, watched a few of my videos, sometimes I keep clicking on the add a tab instead of the make it bigger. So I guess, you guys know that I go movie by movie and I have a forecast. So you can see like the accountant, we're almost done, right? Accountant 2, we're at about 65 million as of today with the Sunday estimates in. And you can see I'm still thinking maybe we get another million-ish. That starts to be a rounding error in the overall forecast. So sometimes I'll leave a little bit in there, like, let's see. A lot of times at the end, actually, just so you know my history, we end up beating, like when I get to the onesie twosie numbers on movies, we kind of end up beating it. Like Amateur is a good example. I have 0 left in my forecast. I don't know if you can see, I didn't show you. This column says remaining. So it tells me how much is left. Like some Minecraft, I'm counting on another 2 million still to come. Won't be surprised if we maybe beat that. I don't know. It's starting to trickle out now that you can watch it on streaming and stuff. But anyway, so you get the idea. Like, I just have how much do we have so far, movie by movie, how much is left, movie by movie. And then that gets me to right now the live tracking, that I still would have to just continue to refine this, is that I'm at a $2.8 billion box office. You can see this is 2819. It flexes up and down every day by a few $1,000,000, just depending on how things do. Like, let's say, this next weekend, Ballerina comes out, and, let's say it has a bigger opening weekend than I expect. Maybe I end up bumping up the overall number for that. And so then my forecast would go up. By the way, just if you ever want to play with this stuff, what you do, like let's take, I don't know, here, Thunderbolts has a lot of actuals. So this goes even deeper because what I do to get to some of my forecasts is I even do, you can see a week by week. So I'm saying like, all right, what's the opening weekend? And then there just tends to be a certain percentage, like a lot of these, let me see one that's still a forecast. Ballerina is a good one. And this is not my final number on Ballerina. I need to think some more still, but some are saying it probably opens kind of, I don't know, 30 to 40 million. You can see right now I've got it at a 36 for opening weekend. Really hoping actually that one could maybe beat, but it just hasn't been tracking, I think, as hot as maybe I had hoped. Um, and then what you see is a lot of times the week that follows is something in the 30% of the opening weekend. Sometimes it can be stronger if, like Sinners, when it had just great word of mouth. Um, by the way, for those of you who are just going to really want to get to the bottom line profits, I promise I'm going to get there quickly. But I just want to kind of show the buildup of how we get to a lot of this stuff. And then there's always just a run week by week of like, okay, how much does it drop? So like Ballerina, the second week, you can see I'm counting on 43%, which means it's dropping by 57%. But you saw like Sinners stayed up way higher than that. So some movies will stay up higher, some movies will drop faster. A lot of times, like a Marvel movie is going to drop hard after the first weekend. Comic book fans seem to really like to go to opening weekend, stuff like that. And then in the out weeks, you start having better and better holds, or better and better legs, whichever way you want to kind of call that. So all that just builds up to the point is I've got this 2.8 billion at the box office. And then in future quarters, what I do, you would end up seeing, so here I got all the movies in Q3, and then I have a forecast for all of those. And so certainly for the rest of 2025, I've got my own forecasts. But of course, the farther out we go, the less dialed in I feel like I am. As we get closer and the industry starts buzzing on different movies, it starts getting a little easier to know. Like Superman lately has gotten really huge buzz. People are talking about some really, really big numbers for opening weekend. I do think maybe people are under forecasting Jurassic World Rebirth. That actually, if you look, I was just on a website earlier today. It was Screen Rant that was showing some of the industry tracking numbers that people get polled in the last like what's your sort of awareness rating and then what's your interest rating in different movies, two different ratings there. And Jurassic is like the top right now of all the movies out there kind of in the coming weeks, coming months. It was even above Superman, and Superman's tracking amazingly hot. So I don't know, we could argue. If you wanted to ask me, maybe I think Superman's going to beat Jurassic, but based on some of these polls, there's some real buzz on Jurassic, and then of course you got Fantastic Four and stuff. So the point is, those closer in movies, I've got more kind of buzz I can go off of, and trailers I've seen myself, and just how do I think I use my own gut too of how I think people are going to respond to different movies. And obviously then in Q4 we get like Jurassic World, and then I've started to look out at the 2026 movies. I have to make some pretty big assumptions in 2026 in terms of what's filling in. And I've always done that for you guys. When I do the farther out forecasts, I'm always kind of guessing a little bit at kind of just an all other, if I haven't heard about some of the movies, they just haven't announced enough of them yet. And so there's just a general sense, even from the industry, that 2026 continues to grow significantly. I've heard that from Adam as well. And you start to get some pretty big things. Like I know Doomsday moved out, but it's still in 2026. It's just moved out to December. We've got the Mando and Grogu movie. We've got some pretty big, like Shrek 5, Toy Story 5 type of stuff. Why don't we go just real quick and double check that I didn't misstate on some of that. So here's my 2026, right? So I can just kind of come in here and, all right, so Shrek so Shrek 5, there it is in Q4. And you're going to see some of this stuff move around. So there's Toy Story that's in June. We have a nice summer. There's a He-Man movie. You've got the Grogu movie. Obviously, I need to still move out. Actually, I did move it out already. So there, see, Doomsday says Q4, 12/18. And then I just do sum ifs. So that's why I need to know what quarters they're in. I probably have that down here. You can just see, yeah. So if you ever want to learn, maybe sometime I'll teach you guys how to do some different formulas in Excel and stuff. So I just do kind of a sum if, and I look for Q4 and just say, hey, tell me all the Q4 movies, which is basically, by the way, actually, I'll go back. So hold on. Let's go here. So you can just see how I'm bouncing around, just tab to tab to tab. So there's a sum if, right? So maybe you just Google that. I'm not going to do that today in this video. But you know how I've said, like, hey, in the future, I'm going to do videos. We're going to look at kind of how you could build up a thesis, even how you could maybe build some tools. So sum if is a nice, if you don't if you don't know like VLOOKUP and sum if and some other things like that in Excel, those are definitely worth learning. Although, gosh, pretty soon here, the AI is going to do all that for us. So I don't know how much you need to learn that, how much you could just tell an AI bot to do all that for you. So maybe people like me who know how to do Excel are going to go by the wayside soon. I don't know. But human insight is always important, and so I bring a lot of human insight to these forecasts. And so far, I've generally been more accurate than the industry on the box office forecasts, and more accurate than Wall Street for sure. So Why don't we, with that, why don't I just show you how I'm getting to some numbers? So based on the overall, so in 2025, actually, let me say, I break out, in the current year, I break out a quarterly forecast. I want to know quarter by quarter, how are we doing? And then I'm going to show in a minute, I'm going to do total of 20, I'm going to do the yearly forecast for 2026 and for 2027. So let's talk through a little bit about how we get to some of this stuff. And I'm going to fly by some of this because I've done past videos, but just so that we can kind of, I don't know, talk about what are all the ingredients in this cake that build up to this total. Because then I want anyone who ends up watching this to be able to yourself kind of say, even at just a kind of strategic math level, like, say an executive isn't going to want to go through a whole spreadsheet, but an executive is going to want to know, all right, from his number, where do I want to, plus up, minus down a few million here and there. And so I'm going to give you kind of that level. So why don't we go through real quick. There are assumptions I make on attendance, and I've told you guys in the past, a lot rolls off of attendance. Somebody had brought up, let me just show something else. I do track, and a couple times I've sort of almost misstated this. There's 2 different percents of revenue I do, and that's why sometimes accidentally real time, my sort of mild ADD, I've said the wrong thing to you guys. So there's 2 different percents of revenue I track. If you look at it as a percent of the box office, of the domestic box office, AMC's admissions, now let's just talk admissions, just ticket sales, have tracked, you could just see quarter by quarter by quarter, kind of hovered, just above or just below 30%-ish. Now you're going to get some weird quarters, like, here, this Q2 of 23 was kind of low. So there's a bit of a blip probably on attendance that happened. That might also have been when I remember there was a whole week of kind of, I almost want to say $1 movies, or maybe it was $5 movies, just across all of America, across every, it wasn't just AMC, it was all theaters. There was a quarter where we had lower, tickets per person basically, and so that changed. But the point is, you could kind of track the percent that we make by quarter. And so in our closer in forecasts, I actually use that. So you can see, like, for Q2 from our domestic box office, I'm actually expecting us to be a bit lower than the last couple quarters, as a percent of our admissions as a percent of the box office. And the reason that matters is then it actually kind of feeds into what I have as a per person ticket price. And maybe I'm just getting too much into the sausage making, but the point is, you could do this in a multiple directions. You want to get to some kind of assumption on ticket price, right? So you can see, for example, I think I'd done a whole video where I did a comparison to last year's actually I did it to last year's Q4, but you can compare to last year's Q3. So ticket price, and once I go through all this once, guys, we'll go fast. You can see, like, in Q2 just now, I've got our ticket price pretty flat, right? Like, it's flat to last Q3, it's below last Q4. It is above Q1, but Q1 didn't have a lot of blockbusters. When you start getting those blockbusters, people are paying, like, think about Sinners and all the IMAX attendance and all that. So I've even hoped that I'm a bit low this quarter and that we'll maybe beat this number. Remember that Adam has put in some premium seats. I say Adam, but the AMC team has put in premium seats in a few locations. We've been rolling that out. So the fact that I'm flat to almost a year ago and I'm down to like 6 months ago, and I'm not that far above a quarter that didn't have a lot of blockbusters, there's probably some upside to this number. What I was saying too then is attendance. I have taken sort of a rate that is basically, it's less than our 3/4 average is what, so you can see I'm dividing by something more than 1, meaning I'm making this smaller. So I took our 3/4 average. If you take attendance at some kind of rate versus the box office, and then take this box office, and then I've said, actually, we're going down by almost 2% versus that 3/4 average. And it's just because last year Q3 was way below what I'm used to seeing. That was, I've covered many times in my videos. We had a kind of a dip in attendance for 1 quarter, but then Q4 was actually way above what I mean, you can see on $300 million less box office, we had almost the same amount of people. I mean, it is 3 million, actually about 2.5 million less people globally at all brands, all countries for AMC. And then even Q1 was actually above where we've been. So something you got to do where you figure out, all right, how much are people paying when they come? How many people are coming? And so you can just see some basic thinking here, very basic, that there's a combination for me of there's some percent we make based on the box office. There were some statisticians who kind of had pointed that out, and I kind of wanted to let them know, like, hey, actually, that is something I already do on the closer in quarters. So there's some percentage based on the box office that we make globally for our admissions revenue. And then there's something around our attendance that seems to shift up and down, quarter to quarter. And it depends, Adam and team have also talked about whether something's suburban or urban. And I've talked to you about whether something's a bigger hit in Latin versus Europe, because AMC's, not really in Latin. We're in Europe, obviously domestically then too. So there's a bunch of assumptions you got to make around uh, our attendance rates and what people are paying. And then the same thing for food and beverage. So food and bev, basically on the current quarters, I think I've got the math on this tab. Let me go. I guess I just literally plugged in a number for this quarter. But then you can see I've got less than 1% growth by quarter after that. So there were just some assumptions I made. And you can see like, there was some napkin math I had used to get to here. I don't have it on this tab. But this 736, if you look, a year ago we were already at 734, and we were at 750. In Q4 715. I'm noticing holidays, Q4 and Q1 kind of seem to be a bit lower, and so there's probably is like, I don't know, maybe more of a, actually Q4 22 you can see was a bit higher. It seems to flex, but there's an overall trend. I've got some graphs on this too that you can just see the while it flexes up and down, the trend is generally up. So here you do have 2 years ago we were at the same number I've got in this quarter. So I mean that feels conservative. Then you start having some quarters above, some quarters below. Just this last Q3, we were at 750 a person, and so you can see I don't even get back above Q3 of last year at all in my 2025 forecasts. So if you look at this 736 and then just basically a percent growth by quarter, there's been a lot of inflation on food and beverage, kind of concessions spending, and then people are also, as AMC has some of the nicer offerings, that some, people are buying a burger or a flatbread pizza. That's different than just buying popcorn or Skittles or something. And then you guys also know that we've started to see a little bit of margin gain probably by just selling our own chocolates. So we've got the 4 different AMC specific, like chocolate covered almonds and pretzels and peanuts and stuff. So that kind of, I'm going to show you the cost side in a minute too. But so that's the revenue side. So if you can kind of dial in the attendance, the ticket price, and the food and beverage per person, then let me talk real quick about the other revenue. That's going to matter too. I think if I was, I don't know, a big player looking at this, I'd probably raise my eyes at how quickly we've been growing. I generally forecast as some kind of, I don't know, factor of the box office. So you can see here what I'm doing is I'm taking our last 2 quarter average versus the box office. But then you'll notice I'm actually, in this case, multiplying by something less than 1. So this is kind of like that other number I was showing you where I'm making it smaller. I'm assuming that we're not going to track perfectly the box office. So for example, I've shared with you guys grocery popcorn. That's not, my thesis is that's not 100% related to the box office anymore, right? Like someone's going into Walmart, whether there's a movie or not. I don't think that's completely tied. Or someone's going into Kroger, etc., or ordering, some popcorn online from Amazon. It's not so much tied to the movies on the popcorn. And I think as that continues to grow and expand, that starts to kind of, I don't want to say decouple. We're going to be coupled with the box office because you're selling box office related merch, right? Like we've got the popcorn buckets and toys and other merch and sometimes even apparel. And what Adam has said, though, that you need to know is he's been expanding, and I've shared with you guys about breadth and depth. So we have been offering a wider variety of product, that's breadth, and we've been going deeper, taking more inventory risk. So say the popcorn buckets, we used to sell out in like a day or two. Now Adam's willing to take enough inventory that maybe in the second weekend we can replenish and sell a little bit more. And so there is some kind of large growth going on. Like you can see For example, in Q4, this is probably where a bit of the popcorn growth and the merch growth really started to hit, because notice that the box office was down 300 million versus Q3, and we had less attendance. That was that kind of 2.5 million less It's like 2.66 or something less attendees. But notice that our merch went up by 24 million. And I shouldn't just say merch. Our AMC other revenue went up by 24 million. There's a few things in there. And then what happened in Q1 as well, that actually blew my number out of the water. I had, if I was to say, here, take this 139 basically, divided by what the box office was, and multiply by what our box office was in Q1, we should have come up with 84 million, right? So if we tracked the same rate versus the box office as just the quarter prior, but we beat that by $20 million. So something's going on where we are definitely growing that other line. And so then what I've said is, boy, that was so aggressive. I don't know that I can count on that continuing. But if I had, so if this is 173, watch this. If I take it, let's even just do some kind of average. Watch. If I take the last like 3 quarters, I should have said the sum of that. Okay, sum of those divided by the sum of those box offices. Okay, times the current box office. Well, that's a bit lower, and that's because in Q3 we hadn't hit that rate. But what if I do like just the last 2? Divided by, oops. Sorry guys. Times the current box office. So I'm just playing around with numbers, right? I don't know, I just did something wrong. But the point is, because this is more like, I'm not quite sure what I was doing live for you guys there. It's bugging me. I want to go figure that out, but I don't want to bore you while I do. So you can see, though, actually, this is the 2-quarter average. Now it's really bugging me what I was doing wrong there, but looks like, I don't know. All right, but anyway, this is the 2-quarter average times our current box office times something less. So somehow I should have come up with a bigger number a minute ago. But since I did that live and I don't want to bore you, it's probably some just really simple mistake I made live there. But that's okay, right? I'm human. I'm not going to worry about it. But I can tell just by looking at this, we're adding these, we're dividing by these, and then we're multiplying by this. So that's your 2-quarter average merch as a rate of the box office, and then times less than 100%. So I'm actually bringing it down a bit and coming up with that 173. So the point is, gosh, this really, let me just do this again. Instead of doing our sum formula, why don't we do this? I probably just didn't put parentheses around. Divided by these guys, oops, times this. I know what I did. Actually, no, that shouldn't matter. There you go. So you come up with 183 million, and so I'm taking 10.6 million out of there, and then the out quarters actually build off that too, because from there then I've just got some rate of growth, and actually honestly 1.7% a quarter, we are growing way, way faster than that right now, and I'm going to show you that when you look at the yearly view in a minute. It looks like in Q4, I don't know. There's a lot of big movies there too that I guess I'm just saying. I think I'm conservative on the other revenue line, and so I have a feeling I could be low. All right, so and then in out quarters, let's go show what I'm doing with attendance. You can see I'm just growing attendance by 1%, okay? Now, you could challenge that, because you could definitely say, as the ticket prices are growing, AMC's bringing in more admissions, yes, but are we really bringing in more people? So then that might be something you want to think about. I am suggesting, like we just opened up there was a new Chicago property we opened up, and I don't know, is AMC, I know we're playing around with the Wednesday discounts. We've got the Tuesday discount day. So that Wednesday half off day has not even started. Is that going to drive some volume? And in this case, volume being people. I don't mean that insensitively, but this is our business, and we're in the business of I don't know, driving people to theaters. So you can see I've just got us growing by 1% in terms of that rate, right? So I do the box office, and then maybe we did 1% better. So as Adam and team are finding ways to drive people to AMC, And, say we're spreading Stubbs list, AMC A list, not Stubbs list, AMC Stubbs A list. As we're getting more members get real sticky, right? And so maybe that's another way we're driving more attendance. So I'm just trusting the team to kind of continue to work on that. And at 1% growth, that's not like it's huge, but you could obviously take that out and play with that. Maybe we'll do that in a minute. But when we get to the bottom line numbers, which is what some of you are like, come on, bro, get to the bottom line. All right, so then you notice we're not growing much in terms of the ticket per person. From 11.45 to 11.48 to 11.59. And this 11.59, notice that's only 3 cents per person above what we just did in Q4. So like the year over year is not such big growth. It should be achievable. Or like, look at this, 11.48 versus the 11.43. So it seems achievable. I've just got some very small growth. And then same thing is going on with food and beverage. Like look at Q3 beats the Q3 that I have now. So I'd like to think these are somewhat conservative. I guess you could question Q4. Maybe I need to go back down to Q4, something like that. But you get the idea of how we're getting to all these numbers. It all feeds off the box office and the attendance, and then you got to decide how much people are paying when they come, and you've got to decide what's the rate of growth of this other line, which is growing, and you're going to see in a minute. It's growing faster than what I have assumed. So now let's talk about expenses a little bit. Because again, I know maybe it's boring to go through this much detail, but if I had a lot of money on the line, I'd kind of want to understand how some dude on the internet was getting to these profit forecasts I'm going to give you by the end of the video. And so, just forgive me. Some of you will just fast forward or play me on a faster mode or something. Okay, so let's go down. There are 3 really big. So I've talked to you guys before. One of the big thesis points of AMC is there are fixed costs in our model. We're going to cover those in a minute. And then there are some variable costs. And a variable cost, for those of you who aren't maybe as deep in business, it just means it moves with kind of the size of your business. A fixed cost is like, so we've talked about rent, right? I'm paying a specific rent on a property, whether I show 1 million movies or whether I show 1 movie. But if I show 1 million movies, I've got a lot of staff hours I got to pay. So then that varies with how many movies I show, but the rent is fixed. It's not varying with how many movies I show. And so what we're going to talk through in a little bit here is these variable costs, and then I'm going to cover some of the fixed costs, and we'll kind of get to everything. So why don't I just scroll over so we can, one of the things I like to do sometimes is I like the label to be right next to the number so you can tell what the heck you're looking at. And that's why some of these, you see how I have like frozen, my top row is frozen or the left column is frozen. So when I move around, I've got certain things I can see. Maybe we'll sometime, for those of you who want to learn Excel, or I know Kitty was saying he was in Google Sheets. So I said I was kind of watching actually his first live. And so I use Excel, but that's because I have it on my computer. Some of you don't want to maybe pay for that. And so you could learn how to use Google Sheets. I'm sure there's some other, if you have a Mac, you've got Numbers, I think it's just called. So anyway, any kind of spreadsheet. What I'm going to show you, so if you notice, let's go through a bunch of quarters. So going all the way back right now to Q2 of 23, you'll notice that we pay back to the studios a % of our ticket sales, right? So you can see here 51.5%. I'm just going to go quarter by quarter. So here's just less than 50. There's a nice real low quarter at 43, but you'll also notice that's a low box office. And so it's not, it's counterintuitive that when we have a lower number, it's not always cause for celebration. Sometimes it just means you didn't have as many of those blockbusters. Like, let's go forward. When we had Deadpool, and we had, a few other pretty big blockbusters in July and August last year, so that's Q3. Notice that, in Q2, when we had 2 of the months were heavily strike impacted, we were down below 50%. Then in Q3, we jumped all the way back up above 51%. Q4 was interesting to me. You notice that, so we just had a quarter where we were well below 50%. You had Mufasa, you had Sonic, you had a few other decent-sized movies. But I think something about the mix of movies and maybe some deals we had with some different studios, that wasn't so high. And then Q1 was, we just really didn't have a lot of blockbusters. Mufasa and Sonic were actually 2 of the biggest movies in the quarter. And if you think through, those were because they had very long legs. And it's my understanding when you have long legs, the longer a movie can run, the exhibitor starts to get to keep a little more percent of the ticket sales. So it's really great when we have those nice theatrical windows, right? Another reason that Adam is trying to negotiate with studios on theatrical windows, not only because you're kind of cannibalizing ticket sales when you put it on streaming, but because perhaps the exhibitors, benefit a bit in some of the out weeks, not like opening weekend weeks. But so you'll see, because I know we have more blockbusters. This Q2 has been fantastic, right? We've had a ton of big movies. So I'm planning us back up at that 51% level. And so what I do is I just take, so let's scroll back where we can see these. So I was just showing you that I'm in line with a lot of other quarters. And so then I just take our ticket sales, right? So that's what happens. You're paying back a certain part of your ticket sales. So let's just show you. We take our admissions. So you can see Excel does a nice job of highlighting what you're doing. Take our admissions. By the way, I could also teach you sometime you can even label cells. So here, instead of it saying AA6, it could say like, oh, that's funny. We're in row AA. Shout out to Adam. Anyway, instead of saying AA6, it would say, like, I could name it and it would say admissions or something. But so you can just see I'm taking the admissions, I'm multiplying it by some percent of what I believe will pay back to the studios, and that's how I get to our cost on the film costs, right? Very simple math. So what you got to decide is just, hey, is this guy keeping in line with what I think? And if you just look, like, let's take, I don't know, how many quarters do we have actuals here? So this is a 9-quarter average. Look down at the bottom. Excel does a nice job of telling you this count is 9. We have averaged 47% over the last 9 quarters, but that's got a bunch of strike quarters in it. So I'd rather look at things that I think are comparable. So here's Q3. That was not a strike quarter last year. That was a nice quarter. We had, like I said, Deadpool and plenty of other big movies. We got to almost a $2.7 billion domestic box office, and we paid the studios back 51%. Here's another nice big, this was the Barbenheimer quarter. In the Barbenheimer quarter, look, we're above 51%. No, that's not the Barbenheimer quarter. Forgive me, I take that back. That was Q3 of 23. We're at 50%. I'm going to call it, 49.96. I'm going to call that 50. Q2 of 23, I think that's probably, gosh, I got to go back and look. You think I'd remember, because that was a nice big quarter. But anyway, that was over 51%. That's, I don't know, let's look at the Maverick quarter too. I think that's Q2 of 22. There's just over 50%. So you can see when we have a bigger quarter, we're definitely above 50. All the real big quarters, although this is just too far back. This was the Spider-Man quarter. Look at that, it's only at like 46.5%. But that was weird times, and I think the studios were trying to help the exhibitors survive, because you can see we were paying some real low amounts, 42, 41. It's climbed since then. So I suppose all I'm just saying, if I come forward, there's a chance. I'd like to think again here that I'm being relatively fair. Like, look at all of 2019 averaged 51.5%. And when we start talking full years, you can see, you can watch it climb. So 22 and 23 were basically 48%. And then 24, actually, so maybe I'm planning too high on 2025. 24, we landed at 48.4. But again, strike year, so maybe I'm about right. Like, we start creeping back towards 2019 levels. I've got us not quite at 50 on the year for 2025. And remember, look at that Q1 2025. So if you take out Q1, I've got us averaging about 51% that we're paying back. You see this average at the bottom. So I think that's pretty reasonable, is my point. It's at 2019 type of levels. It's above where we've tracked for the last couple of years. And it's because, again, those blockbusters, I think the studios, there's just always going to be arm wrestling. It's, I told you guys I'm a supply chain guy. There's this thing called procurement. And it's kind of like, are the buyers or the sellers, in a position of strength? And so for a while, certainly the studios were in a position of strength of saying, like, exhibitors, you need us just to survive. You need our movies. Right now, look at how we've got, let's go back actually and just talk this through real quick, because it's part of my thesis actually of where we're going in the future. And I think you all need to know this, especially if you're thinking about future valuation. Right now, live, real time, we've got Minecraft, Sinners, Lilo and Stitch, Thunderbolts, Final Destination Bloodlines, Mission Impossible 2, The Accountant. I'm just thinking of the weekend we just had. Karate Kid, We had, what else did we have this weekend? We had a few more numbers in accountant, although it was tiny. We had, these are, none of these are any real numbers here that you should look at, but we did have, oh, Last Rodeo, Bring Her Back, Phoenician. Those were all out this week. So the point is, there's a lot of big movies out all at the same time. And my hunch or my thesis I'm kind of working on is at some point you have supply constraints of just how many screens there are. And at that point, the exhibitors start becoming stronger. So I think you're going to move towards more balance between who has the real strength of negotiating power between exhibitors and studios, because as you have more bigger films competing, because what you'll see is like Mission Impossible is on, let's say, 3,000 screens right now or something like that. And, you know, there's only so many screens to go around. And so what's going to happen is the exhibitors will start to say, hey, I've got a lot of good movies I can show. If you really want me to show, especially think IMAX, especially, like there's a real competition for IMAX screens. And so IMAX can say, you know, hey, I can show Mission Impossible or I can show Ballerina that's coming out, and you know, you got to give me a little better cut to make sweeten the pot here for me if you want me to keep your movie on my screen. So that maybe is coming, and my point being then, I wonder if we'll start to see some friendly film costs. Maybe it swings the exhibitor's way a little bit and makes us even more profitable. But right now, I'm just going to keep at a pretty reasonable number. All right, so let's move on to food and beverage costs. What I'll show you, you can see that's swung a bit, but it's always hanging around kind of 19-ish. Why don't we'll just start there from Q4 22. Look at this. Like right at 19, right? 18.99, then 18.7, 18.8, 18.7. We got up to 19 and a half. What I'm starting to notice then is in the bigger quarters, maybe we're a little better. And that could just be, you know, say the team had to order certain things ahead of time. Maybe you get some spoilage. And so you're not having as much revenue coming in to cover your costs. If there was spoilage, it's going to bring your cost up as a percent. So you can see 19.6. These are just what's the literally the cost as a percent of our food and beverage revenue. 19, 18.3, 18.6, and then again, so here's my thesis on maybe spoilage or something. You know, it jumped up on a small box office quarter that we just had. But I mean, in the 3 quarters below, immediately preceding that, we were averaging 18.6, and so then you can see on this Q2 right now and going forward, I've got us at 18.9. So I am thinking that just think of the rate of inflation on our cost is basically staying about even. It is staying even in the way I'm forecasting this with the rate of inflation on the revenue we're bringing in. And so as you if you're bringing in more people, then what's great is we're going to be keeping a lot of revenue. So if you look here, we get to the food and beverage costs. Let me go to Q2. Pretty easy, right? We just take our food and beverage revenue that all was feeding from how much per person and how many people. And then we're just multiplying by whatever cost, which I've shown you that I'm above most quarters, but kind of at an average, because then we have some outliers that are above. Something close to 19%, which we have been at, you know, I mean, gosh, if I take, if I take some like 9 or 10 quarter average, here's a 14 quarter average, we've been at 18.3. But I mean, over in 21, these are way too low. We haven't been at that rate. Let me start here from this 19. Right, and so for the last 10 quarters, well, so the 10 quarter average is exactly 19 pretty much. So I don't know, maybe I'm a little lower, but also you can see like the last couple of bigger quarters, Q3 and Q4, that we had nice quarters, was only 18.3 and 18.6. So if I said, all right, we're going to drop back to like, I don't know, 18.4 or something, then let me just see what that did to that added about $2.5 million of profit just in one quarter. Okay, it took this 86.5 to 89.17. So you can play with that. But I mean, it's not going to swing it wildly. Certainly, I'm not way off. We've averaged about 19 for like, you know, however many quarters. So I should be about right on that, I think. We'll see. And again, you know, our inflation on the cost side is not outpacing our inflation on the revenue side. Is really what I'm just saying. We'll just keep pace. And so as you're bringing in more people, then we're good to go. We're, got nice margins on those. OpEx is going to be a real big one. So here's the other thing. I would just notice the film costs and OpEx. Do you notice they're like twice as big as the next, there's rent. Those are our 3 biggest costs. And of course, borrowing is a big one. But really, OpEx and film costs are the ones you want to dial in. So film costs, again, it's just roughly half. We're paying something a little more than half probably on nice big quarters. And so you can just see though, then when you got a real big quarter, um, that's going to be a higher number. And so that's one of our biggest costs. And then OpEx, let's talk through, because what I've got a pretty funky formula for that right now. And I'm continuing to have to dial it in because it swings. But I know, so Adam has talked about operating leverage, right? And there's where I've talked to you about fixed costs versus variable costs and all of that. Let's say, again, let's go back to like, a savvy business person will understand what I say when I talk about SG&A. And so let's say that I am paying a staff, I've got a general manager at a property, and I have that general manager I'm paying whether I, again, show 1,000 movies or one movie. And so you can just imagine I am spreading my costs. I suppose that in a way, I know I'm almost talking about that as a fixed cost. You guys who know business know what I'm saying there, but I'm going to come back to this in a minute. So for that one employee, I'm paying them no matter what, right? And so what you'll see is there's a certain amount of like there's an HQ. We got our headquarters. Adam had hired like a VP over the food and beverage, and kind of the popcorn distribution and all that stuff, right? So you're paying that VP regardless. So there's a certain amount of overhead we're always going to have. So you can see what I've done for the OpEx. Let's go out here. Oh, I know. I need to go up here where I'm actually calculating it. Pardon me, guys. For the OpEx number, notice I've got this constant. You math people will call that K. My K is 156, okay? So I have just in general said, there's some piece, so what we need to talk through is there's some piece of this that's tied to the box office growth. So let's go back to this one movie or 1,000 movies. If I have, more people coming, right? So like here, this quarter, I've got us, bringing in 11 million more people than in Q4 of this last year, because the box office is almost $500 million bigger. The box office is up in my forecast, $482 million. And so to bring in, 11 million more people and realize all of those sales and to pop all the popcorn. And I've told you guys before, you're going to flush the toilets more and have the AC or the heat running more, and you're going to have more showings, and the laser projection is costing, electricity is going up, et cetera, right? So the more you do, yay, we're making a profit, that's awesome, but you still have some expenses for that. And so what I do is I say, listen, there is a chunk that seems to track, and based on my methodology here, and so you statisticians are probably cringing because there's something far better you could do to get to some, I'll use the term best fit model, and you guys could have figured out, I've seen a couple people commenting on my YouTube who claim, and I think I'm going to believe a couple of them, that they have like a PhD in stats and all that. So you guys could come up with this best fit model and back test the model and figure out, so somebody do it and send me. I mean, maybe I'll even work it in. If you can show me based on history that you can build a back tested model, so you guys can hear that at least I can sound smart about this stuff. I don't know that I could totally build it on my own. Well, never mind. I'm not going to go off on tangents here. But so anyway, the point is there are people who could come up with smarter models to predict here than I. But I've been at least close, and I've told you I continue to beat Wall Street on the overall earnings forecasts. And so the point is I'm taking some fixed amount that I just say, OpEx, we got some amount no matter what. And then the rest of it I'm making variable, where I'm just saying there is some percent based on, I'll show you actually, based on our revenues we're bringing in. So, and I'll show you in a minute too, just to give you an idea of how conservative or how aggressive am I being. So right now I'm saying this number 21%, right? So what we do is we go, we're going to take the sum of our revenue. So I'm just taking total revenue. And it makes sense, if you're just high level business person and you go, there's activities and there's a staff and there's marketing and there's whatever. Sorry, I kind of cramped on the words there because I don't know actually if we're counting marketing here. A lot of times you might have demand creation somewhere else, but doesn't matter. The point is there's some overhead to have my business be bigger, right? Now, Adam has told you about operating leverage, and I agree. And so I'm going to show you how I get to operating leverage in a minute. But so I take a percent times our total revenue, and then I add this constant. And that's how I kind of get to our total OPEX number. And so what I am doing is the bigger the box office, and really by that, just the bigger our revenue, I know this percent goes down. And so that's that operating leverage. So like, let me show you, here's one. So here was that. This is the Barbenheimer quarter. Like our OPEX using this same math. So you can see this one's more backwards mathed. There's that 156 and all of that. And so the backwards math, once we get actuals, I look at it backwards. And so in that Barbenheimer quarter, our OPEX, this percent you would use for the way I'm calculating it was only 19%. And then you can see actually, I keep doing this to you guys. That's not the Barbenheimer quarter. So then we did jump. Popcorn started to roll out, right? And so we probably even had some costs in advance of that. And then when the box office is low, you can see, and this is why during COVID it was such a problem. Well, this is part of it, and then all our fixed costs are part of it. But the lower the box office, the less you can spread out those variable costs. And so this number starts going higher in our actuals. And then that's why this, last Q3 was a bit of a gut punch because, and that was just that attendance. I've covered that 100 times. But, compare that. Here was a $2.6 billion box office, only 19% on that number as a cost. And then we had a $2.6 billion box office and 22% as a cost. So I had gotten our OPEX wrong that quarter as well. I don't mind sharing that, guys, because, look, almost every quarter for 3 years, I've been at like high 90% of accuracy. So I'm going to hope that I can continue to get us there. But then we got to own it when we get it wrong, and we got to learn. It's just a growth opportunity. That's fine. All right. So the point is, like, let's look at, Q4 we just finished. And look at this. Our operating expenses as a percent of revenue, less that constant I was just telling you about, were lower, even though the box office was lower, if you compare Q3 to Q4. And so that told me, okay, we're kind of tracking back towards some better level that I'm kind of liking. I remember something, actually. Let me go back here. This Q2, where is it? No, I'll take that back. Never mind. Let's just keep going. Okay, so the point is you can then see right now I'm counting us because what you got to do is just say, all right, if the box office gets real big, if our revenues get real big, this number shrinks because you don't need another general manager when you have those 1,000 movies. There's one general manager for one movie and one general manager for 1,000 movies. There's that VP for all of our food. I apologize. I can't remember her name. I believe she came from Pepsi Frito-Lay. Very qualified individual. Please forgive me that I don't remember right now. Got a lot going on in my life. But, we hired this well-qualified executive who's doing a great job expanding our distribution of popcorn. But she was working whether we were in one door of Walmart or 10,000 doors across Walmart and Kroger and other brand names. Okay, so you start to spread out the cost is the point. And I believe that I'm being conservative. Let us find out. I am hopeful we could beat this number. But again, I don't know because popcorn is the one really throwing me sideways and candy because now you've got probably a team at the center who's running that. And so back to that SG&A. I know there's some cost. Got a team running that. We've got this distribution going on and marketing and whatever. So I don't know. We're going to have to find out over time. And that's why the PhDs in statistics could backtest some models. And then you'll notice that I bring it back up. But again, I think maybe conservative because look at this. In Q3, I'm using a 20% sort of 21% cost modifier. But look at, we had a lower quarter in Q4 and we were under 22%. And so let's just see if basically across these 3 quarters, what I'm telling you is I'm trying to be careful with our OPEX and keep some relatively high cost in there, okay? And then you can even see it starts to be a little bit less tied to the box office because remember we've got that other revenue growth as well. And I'm gonna have to dig in, like as I'm even looking at this, I don't know why we would have, I've got basically the same OPEX, and I've even got us climbing in Q4, even though this box office is lower than in Q2. So I got to figure out, maybe I'd have to calculate that differently. So kind of, showing you guys the sausage making, and where you could kind of challenge me and say maybe it's wrong. All right, let's keep moving. So the point is, though, OpEx, I have some amount of it constant and some amount of it kind of flexing up and down, and we will see. But, like, let's say you said, no way, like, this is only going to be 18%. So let's look at this 86.48 number and watch this change. If it went down a bit, like, boom, I've just added, what was that? Like $17 million to our profit, 16 and a half, pretty much. So that is a big deal. OpEx is a big expense. And I mean, you can see, just even if you want to go more like, napkin type of math, on this $2.6 billion box office, our OpEx was 450. I've got a 6 million above that, on this $2.8 billion box office. So hopefully somewhat conservative. All right, let's talk rent. Rent's a little easier. So in fact, OpEx was the weirdest one. You're not going to see any math as weird as that. For a long time, and I used to chart this for you, our rent was generally trending down, but somewhat consistent. I mean, when you got a lease, and if you've got a multi-year lease, you're just paying the same rent in general. I don't know if in our leases we've worked in some kind of inflation or anything. I watched it be fairly consistent, and you can see, like, let's just look at the last year or so. So we were at 225, we dropped to 218, we dropped to 216, we dropped to 214. You see how that's going? But then we popped back up to 218. Maybe we started paying for that Chicago property, for example, or something. Or, you're going to renegotiate some leases. Maybe some leases kicked in at the calendar year. Pardon me, just taking a drink of water here. So maybe some renegotiated rates kicked in, and that would make sense, right? You're a landlord. Say, all right, AMC, you survived. I'd like you to start. I'm going to go ahead and increase rent now. So just normal stuff. But I mean, 218 is historically lower if you go back a ways. I mean, look at in 2019. By the way, again, part of the thesis, here's in 2019, our total rent on the year, 968 million. But look at 2024, we just finished. So from 968 million to 873, so almost $100 million a year less in rent. I mean, that's, granted, you don't have those properties. So there were a lot of properties that were closed. Some of this is just from being renegotiated. You don't have properties maybe that could have generated revenue, but in general, if you think about a property mix, the team has closed down underperforming properties. So we're far more profitable than in 2019. That's just easy to see. And you can see then, if we stay at this 218 a month rate, or even just a touch lower, weren't we just 273? Does that sound right, guys? Whoops, nope, we were at, oh no, I got the wrong, hang on. So we were at 873 is what I meant, sorry. And we're at 872. So pretty much flat to last year on rent is what I've got for 2025. In a minute here, we're going to just talk 26 and 27 at a year level. So hang with me, we're kind of almost done. M&A, I don't almost care about it. Like, I don't know. I mean, we did have a blip up to 3, but look at this. Like, it's always, 0.7, 0.2, negative 0.1, which means that was income, 0.1, 0.1. We don't need to even talk about it. I'm just going to move on from, I just keep a smaller amount in there. You can see 0.2, 0.2, 0.2. I'll just generally assume we're going to have a look, but I mean, that's, even what I've got is higher than our history, but I mean, that's just $200,000 a quarter, so that's a rounding error. All right, so there's two different others, actually. We're going to talk about that in a minute. In general, why don't we just look back? You can see somewhat consistent, right? Let's forget Q1 of 23. So 54, 57, 58, 49, 54, 66, 56. So you can just see, I mean, that's wild guesswork for me because I don't know everything that's in that. But I've just kept it mid-50s, and you can just see that's, I mean, here's the, let's go back. So I don't know, an 8-quarter average is about 57, but with some outliers, right? And here's one well below, and here's one well above. So 55-ish seems about right, or you can see in the out quarters here, I've had 54. So your best guess on that one, but it's going to be mid-50s in general, it seems, and then with some outliers. Okay, depreciation and amortization. Now that has trended down quarter after quarter after quarter, right? Like watch this, 114, 106, 104, 102, 99, 97, 97. Little blip back up to 103, then 94. 97, but then dropping 89, 86, 82. So that's, no, we're not there yet. So 79, 81, 78, and then the quarter we just finished 76. Okay, but I have talked about, and Adam has signaled to you that there will be there'll be an increase in CapEx. And so especially if you were kind of a more sophisticated investor, you want to think through, all right, they're going to increase CapEx. Some of that's going to be capital expenses, guys, so CapEx, which will be able to be depreciated. They're longer term investments. I don't know the accounting rules, for example, on these premium seats. Like I know as a former landlord, you can't depreciate furniture, for example, because it's not a long-lasting asset. But and you accountants can correct me if I got that wrong, but I'm saying that based on memory of a conversation I had with my CPA a long time ago. Anyway, basically, sorry, derailed myself. Oh yeah, so these premium seats in a theater, though, I'd like to think, I mean, they are multi-year assets. You're not going to replace them very often. So do you depreciate those? And then that matters because then I didn't assume that depreciation will keep going down because we're at some point now, we're putting in these new lasers, we're putting in new seats. If whatever other investments Adam and team are making, there's going to be some amount of those that are depreciable, which means your depreciation actually starts to go up. And I had said that a while back. In fact, I think I made a video just days before Adam announced the Go plan, and I had said literally, so I told you guys sometimes it's better to be lucky than good. I got lucky with the timing on that one. I did not know he was going to announce that. I mean, how could I, obviously? And so I had said, hey, at some point, because our business is improving, we would start to invest more in our future. That's CapEx. And then sure enough, he announced the Go plan. And so that's what you're seeing. But then that may create more depreciation, which is reported as an expense. So I'm just trying to let you know, I've got sort of a balance of, on the one hand, depreciation's been going down. On the other hand, we're investing, which will drive it up. And so you can see then I basically keep it flat from Q1 to Q2. So that's the competing pressures of going down and going up, just balancing each other out. But then I start having it creep up. I'm starting to raise it a bit. So I'm not sure, you maybe more savvy folks can decide if any of you knows a bit more about kind of the timing of CapEx and what's depreciable and all that stuff. All right. I had shared on the live, but I think it may have even got cut off in the glitchiness. If you look at goodwill impairment, why don't we just show that too? The last few years, let's start from 2022. I'm not going to talk a lot about goodwill impairment. The people who need to know about it probably already do. For the rest of you, I've got a whole video on it because we had gotten trolled on that and someone tried to scare you all that would have to do with bankruptcy and stuff. It is a non-cash expense, as is depreciation. So it's a non-cash expense, sorry, distracted myself because I was thinking about explaining amortization, but let's not go there right now either. Anyway, so it has to do, there are tests you can do for that of is an asset generating the cash it's supposed to generate. So that's one discussion. The other thing that I have hypothesized or speculated, I've speculated that maybe some of these properties we sold off could have sold at a loss or could have divested of them at a loss and still owed some money or something like that. And so perhaps we've been writing off the loss over time, and that has been this impairment of an asset that we, basically took a loss on. And so you'll note that it's always showing up in Q4, but you'll also note it's going down significantly. So from Q4 22 was at 133, the next year was at 107, the year we just finished it was at 72. So I'm basically taking it down by some rate, and I've got us at 29 this year. So a non-cash expense, but I am still counting on it, and I'm just having to make my own wild guess. I don't know the accounting rules completely. I don't know the rate of sort of deceleration or acceleration, or whichever way you want to look at that. And so I'm just saying, well, all right, we went down by, 26 million-ish, and then we went down by, 30 plus million. Was that 34 million? And so then I think I've got us down by 40 some million here. Was that like 43 million? I can see that it was kind of accelerating. Of course, that's only for 2 years, so that's not totally a pattern. But the point is, there'll probably be some impairment, and I think this is the last year. Is also my hunch. This might be the last. And the thing is, if we're generating so much more cash this year, Adam and team have said the last 9 months are cash flow positive, and a part of the test of impairment is whether an asset is generating a certain amount of cash that you had kind of valued it on your books. Then maybe we could even have zero impairment. So you need to know then as I finally round out to the earnings and then the price to earnings valuation of the stock, I do have this $30 million in here of impairment this year that I don't know the accounting rules enough to know whether that's gone or whether we still have that this year, or whether I even have the right number. So I'm just admitting to you all it's a bit of a guess, and I'm keeping conservative and I'm keeping it in there. All right. Then our other expense slash income. If you ever see this as a negative number, it's income. I believe, now here's where I could also be wrong on, here's where we need the real CPAs in the room. Remember that there have been seasons in our history where we have paid off debt basically at a profit. We've paid off debt at a discount. And Adam has to, the team has to account for that somewhere. So either that's been showing up in our investment expense or income, or it's been showing up in our other expense or income. And you'll see how this is fluctuating, which is why I think it could have been here. I'm not too sure. And there's going to be different things they're doing in terms of how they're managing our cash as well, although that's really going to come in the investment line. But this is just a wildly swinging number, and so I just have to keep a plug here. So again, you're seeing some of the sausage making that, here's a 31 to our favor. So that's income. 13 to our favor, then 64. That was a pretty big number. Then 43, 108 back in Q2. Now you'll note I believe that's not when we refinance. Gain on it. Oh yeah, actually the team had noted that. So there you go. So I should just consult my own notes. You can make notes in Excel too, guys, as you're seeing. Thankfully, I've already told you guys my name. Otherwise, I'd be doxing myself here. But you can see the note from Eric Thompson. Thank you, Eric. Anyway, so gain on extinguishment of debt, also lawsuits. Oh, yeah, the lawsuit settlement was in there, too. This is why I make notes sometimes, guys, because if I need to comp year over year, I need to remember, hey, don't count on that again. So we had a settlement lawsuit. We had received some money, and then we had that extinguishment of debt. We had paid off some debt at a profit or at a discount. And then you can see negative 23, but then there's a positive. This is an actual expense we just had in Q4. And then Q1 was really big, negative 59. So I don't know what to count there. You can see how wildly that swings, although usually pretty well to our favor. But look at how that sometimes it's quite the other way. There's 136 in Q1 of 22. That was an expense. There's a positive 39. That's an expense. And so you'll just see I keep a pretty small number. And most quarters, it's been in our favor, much bigger than that. So let's not count that outlier quarter. But if we take the last, what is that then? 7 quarters, not including when we had the lawsuit settlement and all that, then you've got 30 million a quarter in income. And then you can see here in Q2, I'm only counting on 3, and then 10 and 10. So don't really know what to count there. That one's I have no clue how to predict that. So I guess I'm revealing a weakness to you all. Never do that. Never let them see you sweat. But that's fine. So for anybody who needs to kind of think that through for your own thoughts on the valuation. What I'll just say too, though, as I'm showing you all of this, and we'll finally pull up here pretty soon, a few more minutes, hang with me. What really happens is in forecasting, when you get down, the more granular you get, the more wrong you're going to be on a given line. Although some of these have been pretty accurate. But overall, if you blend it, there's one line that was bigger than you thought and one line that was smaller than you thought. And the absolute value, that's where I've been real accurate, is kind of the bottom line. And I have been beating Wall Street on that. Okay, so borrowing costs, that's been I don't know, quite the discussion. You know that interest rates have gone up. So, by the way, we have to do a video sometime on news. But one of the big news items today that I'll just digress on. Did you see that there's a pretty big rumor going around that Jerome Powell is resigning tomorrow, or if you want to call it that Trump is firing him? Potato on that one. There's some splitting hairs, perhaps because of the legal arguments about whether Trump can even fire him. But the rumor is Jerome Powell is retiring tomorrow. Or resigning, I should say, resigning from that position. So let's see what happens with interest rates. But you can just see it in the numbers from when we refinanced. And the refinance was absolutely the right move. You remember that Adam pushed our debt out from 2026 to 2029 and 2030. And so certainly we have the runway, because when I show you the profits in a minute that we're going to be making year by year, I really think that AMC is going to be in a position of strength as we go forward, and is going to be paying off our debt. And I'm not concerned about that at all. But you can see that, you know, before that we were paying about 90 million a quarter in interest payments for the most part. This is not just, it's basically interest payments. But then you can see we jumped to 110 and then to 112, back down to 109. And remember that I've shown you in other videos that we've been paying off debt a little bit. So we're down to, we dropped below 4 billion now. Our debt is 3976, I think. It's either 3976 or 3975, which is well below pre-COVID levels. So that's nice to see. And so I think pre-COVID was, so at the end of 2019, December 31st, 2019, it was like 4.7 something, maybe 473. And so we're almost $1 billion below the 2019 debt. And now we're going to be more profitable than in 2019. Okay. So, but you can see I'm counting on staying at 109. Now this is where you could get real debatey. And usually I would have changed these before I show them to you guys, but I'm just going to leave it as is. What I do, so you can see in Q2, our current quarter, I left our borrowing costs flat to Q1. All right, we just finished a real quarter. I would argue that probably some of the debt we paid off, I want to say we paid off like $30 million plus. Some of the debt we paid off, we probably didn't see the interest savings from that completely. In other words, across all 3 months of Q1. And so maybe I should have, you know, like for example, if I said, why don't we take, you know, $500,000 out or $1 million out, you know, I could have subtracted this and then our profits change. I'm not going to worry about that. It's not going to be huge. We only paid off 30 million in debt. I mean, I say only, but I'm still thrilled about that. But the quarter to quarter cost savings on that at most is $1 million probably. And it'd be less than that. So it's not even going to be $1 million. So I'm just going to let this one ride and I'll just keep it conservative for the quarter. But now you'll notice future quarters is dropping significantly. And here's my assumption. It's a two-part assumption. And you're going to then see this when I get to 26 and 27, and I'll show you. I believe our cash flows are going to be so significant now that Adam and team will have some amount they're going to choose to pay down debt. Okay, so that's assumption one, which reduces your borrowing costs. Assumption two is at some point here, Trump wins the arm wrestling match and starts to get rates down a little bit. Now, I don't know. You know, there's the inflation conversation. There's the tariffs conversation. I did see, forgive me now, I can't remember what it was, PPI or CPI. So there's a producer's index and there's a consumer index. And I think it was the producer index. No, you know what? I think it was CPI. I think it might have been the consumer index this last week. And year over year, it was 2.1%. And the Fed has always said their target rate is 2%. And so, you know, your reading of the tea leaves and which way the wind is blowing is going to be as good as mine. But there's some assumptions you need to make. For every 50 basis points. Oh man, now you guys all, this is why I like recording, because I would have gone and looked this up. What did Adam say? Oh, is it maybe 10 million a year? I don't remember. I'd have to go think about that. And so, you know, but it's just on the, man, I almost want to do the math for you in a spreadsheet here real quick, but watching me live spreadsheet it probably isn't the most fun ever. But you can take our 3.7 billion. We pay, generally we pay something around 10 or 11% a year. And then, you know, take a half a point off of that or something. And then what does that get you? So that's closer to probably almost 20 million a year or something like that. But you guys get that, there's some savings due to interest, and there's some savings just by having less debt. Okay, so you can see that I am taking out 6 million. That's probably aggressive in Q3, and I took another 9 million out in Q4. Perhaps that's a little bit over aggressive too. It'll all come down to how much do Adam and team pay down, and do interest rates even move. So I think if I was to go do another forecast, maybe I'd consider it. And I mean, even live, like all we got to do is just say, well, what if we just make that, we're only going to reduce by 4, we're only going to reduce by, I don't know, 5 or something, right? So we'll mess with that. before the end of this video, maybe. So you get the idea on that. You need to think through how quickly is AMC paying off debt based on cash flows and sort of a safety level of Adam keeping a war chest, and then how, or if at all, is the Fed lowering rates. All right, we can breeze by the next two. So lease obligations, you will see that that is pretty consistent. Look at this. 1, 1, 0.9, 0.9, 1, 0.9, 0.9, 0.9. There's a little dip, 0.6, 1. I don't know why Q4 was 2.9. And then we just had 1.2. So you can see going forward, I'm back at our average of 0.9. Not sure, perhaps that could change. Let us watch that and see. And then non-cash, so remember non-cash, right? So that's the interesting thing too at AMC's bottom line. There's a lot of non-cash stuff, right? So we've got depreciation and amortization. We've got that goodwill expense. And we've got this NCMI. So you know that AMC is part owner in National Cinemedia, which does like a lot of the advertising and stuff at the theater. So when we're watching those ads beforehand, Maria, is it? Oh man, of course I know her name. Menounos? Oh man, I need to look up her name. I'm sorry. I apologize to her. So anyway, got all these ads beforehand, and NCMI is part of that, and then AMC is part owner in that. And so, by the way, you can track that stock too, because now let's talk through investment expense. But just the point is, year after year, quarter after quarter, you can see it's basically 9 million a quarter. Been a little bit above, but lately a little bit lower. You can see, so Q3 and Q4 and Q1 was 9, 9, and 8.9. So I'm just taking that as a signal that, all right, we're at 9 now. We used to be more like 9.5. And so I'm just booking that quarter after quarter, year after year. I'm keeping AMC in that cost. All right, so investment expense or income. You can see we have a couple nice ones. So I have shared with you guys the top level. Remember that we own NCMI. You can track that stock. We own Highcroft. I believe that's 2.3 million shares. Don't quote me on that. I got to go back and check. And that's reverse split adjusted. And then we own all the warrants too that I don't recall the expiration date of those warrants. Can't be too far out. Maybe a year or two at most, I'm thinking. But I'd have to go check that too. And so from day one, or really kind of the midnight of the ending of a quarter to midnight of the ending of the current quarter. So from sort of day one to the last day of a quarter, if you track the movement of Highcroft stock and the movement of NCMI, and you figure out how many shares AMC has, so we can go double check that, then the delta in the price from day one to the end is recognized as revenue or expense for AMC. So multiply the share price change by how many shares we have, and you get this this investment expense or income. And you can see, so like for a while we had some expenses, right? Because Highcroft was going down. There's a pretty big one. Oh, this is when we bought in probably. Although I thought it was before that. I don't know. Maybe that's when we bought. But then you can see, so there's expense, the stock was going down. Nice quarter, it goes back up. Probably some things about NCMI too. But then more lately, Q2 last year, we were up 6 million. Up 3 million, up 2 million, up 6 million. If you want to get conspiratorial, I have shared a lot of times Highcroft is allowed to run early in a quarter and kind of depressed in price later. And often I've surmised that could be related to AMC's earnings. If you can keep that stock from running, then AMC doesn't get to recognize those revenues. But I don't know. I don't think it's mattering as much anymore. And that's very tinfoily. I know many of you have asked me to do a Highcroft video. Probably going to be more to do with when does Highcroft start pulling metals out of the earth. And then remember, NCMI did go through bankruptcy, and that did impact AMC's shares that we were holding. But now we've been sort of in a way replenishing those shares. Basically, the exhibitors share ownership of NCMI. It's kind of across the exhibitors. So you can see, you need to just think through the timing of when do you think Highcroft stock starts to move really in our favor. The famous story, if you want to go look this up, is there was a quarter where Amazon actually did not really grow in terms of core Amazon. This is maybe 2 years ago-ish. And the stock went way up because what happened is Rivian stock had exploded, and Amazon owned Rivian stock and recognized all the revenue from that stock going up. And it made Amazon look like it had a really, really great quarter, even though if you actually dug into the operations, it wasn't operationally driven. It was driven by the Rivian share price change. So my point is, you can see some real benefit to a public company owning shares of another company, and that happened with Amazon and Rivian. I think Amazon since sold off Rivian. I'd have to go double check that that's a fact. Do DD on that. But so that's the point, is this does impact. So you got to decide the timing of and the direction. What do you think is happening to Hycroft and NCMI, and when do you think it's happening? So you'll see in Q1 that we just finished, Hycroft had a nice quarter. So you can see AMC had 6 million in revenue recognized between the two. I think NCMI was kind of up also. And then generally I'm being somewhat conservative. So here in Q2, I have only 3 million growth in this line. I'm sure that probably there's, as we start to hold more and more cash, maybe we're counting on any, if Adam and team are doing any, I don't know, sound investing or strategic moves with any of that. You've seen how GameStop, for example, has invested in different securities. And I'm not even talking Bitcoin there. I'm just talking about different, like government securities in particular. And so you can have maybe some cash flows from the team investing there. But then you see I've got some bigger numbers. I start to grow it a bit. And that's just me kind of guessing, wild guess, that maybe as time goes out, do those stocks start to climb? Do we see a nice run? Certainly interest rates would impact that too. So you could kind of say, well, I don't think so, buddy. Like, maybe take this down and you take this down or something. It's not going to be significant shifts if I start to show you what our overall earnings. So let's get to the bottom line. Actually, one last thing, I suppose. We got to count on taxes. I don't know what to count on. Let me just show you a comp. If I go back to that Q3 of 2023, when we had positive earnings, you see this $12.3 million number down here. Let's just line that up. So we had 2 quarters with earnings. And I think I don't know if we're offset by a quarter, maybe not. But so you can see we had positive earnings of 8.6, but we probably had a lot of carryover of losses that offset a lot. And so we barely paid any taxes. And then we had this positive earnings of 12.3, paid taxes of $2 million. So I right now have mid to high 80s of earnings. Again, it's a live number. So at some point, when we're close to the earnings call, I'll lock in something else. And so this is not like I'm publishing an earnings number, but right now live, as I'm tracking, I've got us in the mid to high 80s based on every boring thing I just walked you all through. And then I've got us included in that earnings number is 7 million in taxes. You can just see, like I said, that was, here we made 12 million in a quarter and we only paid 2. So I don't know what level of taxes we'll be at. And you can just see going forward, I'm counting on more taxes than we've kind of ever paid. Let's go back to 2019. In 18 and 19, so there was a Q3, that was a loss that quarter, but it probably, I don't know what the accounting rules are on what couldn't be counted and stuff. So, but here in look at 2019, we're only paying 6 and 5. I don't know what to call that. Maybe there's some carryover from this that's a pretty big earnings in Q4 2018. And then you see the next quarter was these taxes. Obviously, I somehow didn't copy down. But anyway, so that is still guesswork as well. I have to guess at what our taxes are going to be. But you can just see, at least I'm not counting on nothing. I'm counting on, we've never paid more than 1 or 2. In a lot of quarters, we've even been able to claim a loss. Let us see where taxes go. And then finally, why don't we look at a year? Let's pull up to year levels, and then we're going to jump to the stock valuation. Okay. So let's highlight these 3. Okay. So actually, nope. Let's highlight these 3, 25, 26, 27. So bottom line for 2025, you can see I'm planning on us paying 25 million in taxes, but for all of 2024, we paid 2. And for all of 23, we paid 3. So you get the idea. Like I'm planning on a jump because I believe we're profitable now. And then our bottom line earnings on the year right now, I've got us very, very close to 0. But remember that our first quarter, we had a loss of $200 million. So that's the radical shift. And I told everybody the shift was coming in April, and the box office has been showing that. I published earlier today a post on X. The Q2 is tracking $900 million ahead, June 1 versus June 1. This year versus last year, the box office is almost $1 billion bigger on those first 2 months. April and May were almost $1 billion bigger than last year. That is not a small amount. And so we've had this radical turnaround. We've got Avatar and Superman and Jurassic and Fantastic Four. We got a lot of big movies still coming out. We got Zootopia too. You guys get the idea. So I've got our last 3 quarters, which is what I always said. These 9 months would be our best 9 months in many, many years, and starting to almost get comparable to compare, a 3-quarter period in pre-COVID. We're starting to get there to a similar. And then look at the yearly box offices. In 2024, we were only $8.5 billion. I've got us tracking $1 billion over last year. For a while, I was bigger than this. I told you in another video that I kind of had a couple spots I had to trim down. But let's see, maybe, what if Avatar crushes my expectations, or Zootopia or something else crushes my expectations. And then because it's going to matter in a minute here, we're almost ready to talk about stock valuation. So in 2026, I took some, I showed you that I looked at all the movies. Like, there's some big ones, right? Like, I just saw Moana. Where did that go? Moana live action. We got Toy Story 5. Toy Story 5 is going to be bonkers. I don't even know how big to make that. Mandalorian and Grogu. So we're starting to finally have some Spider-Man IP. Don't forget, Spider-Man Brand New Day. Jeez. Spider-Man No Way Home was one of the biggest movies there's kind of ever been. I mean, I was up there. DC starts to bring some more things. We got Clayface. There's another Insidious. I mean, you just get the idea. There's a lot of big stuff. There's actually another 28 years later. It's kind of the second half of that. Man, a lot of big movies next year. So that's going to be a lot of fun. Super Mario Brothers. Dang, that's going to be big. We get a Mummy reboot. So we got a lot of fun stuff. Even like I said, even though Avengers Doomsday pushes to the end of the year. And then, by the way, I mean, so you could see, like, let's take Avengers Doomsday. Who knows? I mean, you could argue, like, what the hell? Like, sorry, I don't usually talk like that. That just slipped out. What the heck? He's got 600 million. But then also notice, I'm taking almost 200 million of that and saying it's not even in 2025. Because that comes out, only a few weeks of December. And so I factor in how much rolls over to 2027. I said 2025 a minute ago. Obviously, I meant 2026. And then what I've got for each quarter is, because there's not enough movies announced, I have some plugs. So let's go back. So the point is, 2026 is a blend of the actual movies and some plug numbers. And so there's some percentage growth too. I mean, if we just, why don't we just real quick say, what is this as a percent growth? So it's 8% growth, right? That's not that much. So I've got 2026 growing at 8% versus the current forecast for 2025. And then 2027, you can literally just see it in there. I've got 6.5% growth. So I'm not doing anything real huge. We had, remember that Q1 of this year was still, I kind of called it in a way a strike blip. Like, we had recovery, but then there's sort of an air bubble in the water pipes kind of a thing that we needed to flush out. So we didn't have a very big quarter, but Q1 next year, well, I mean, let's even just go back to what I was just showing you. We're going to have carryover revenue from Wicked 2, well, maybe. I mean, that comes out at the end of November, so is that really done with its run or not? Oops, I'm in the wrong. Oh, yeah, okay. Anyway, and then Zootopia 2 and Five Nights at Freddy's 2 and Avatar. Something I can, you know what, I just realized some of these have flipped. This is the Avatar number. I don't know why these are titled wrong, but this 260, this is absolutely the Avatar number, not the Wicked number. Because there's no way I'd count on 0 from Avatar 3, and I remember what happened now too. So sorry, I don't think I feel like splicing this video and fixing that, but that is, that's from Avatar, not from Wicked. But anyway, why don't we keep going? So the point is, Q1 of 2026 is going to be a lot better than Q1 of 2025, especially just on Avatar. And SpongeBob comes out towards the end of the year. That's going to carry over a lot of revenue. So that's really helpful. It's going to be much better. And so on the year, I just showed you, what did we say? That I had like 7.9% growth maybe? Sorry guys, I've been talking a long time. 7.9% growth, and then the next year I only have 6.5% growth. So maybe the box office could grow even faster than that. And then you'll notice on the ticket prices, I'm only growing at 2%. Both years, 2% growth on ticket prices. We've been growing, and actually 25, I don't have very much growth either. Notice how it only goes up 5 cents a ticket versus 24. So do bear in mind 24 has also Beyonce and Taylor Swift, which were inflated. Those were higher prices in Q1. But anyway, so I mean, I'm only growing tickets at 2% per year. I'm growing food and beverage per person at less than 2% a year. So this is 1.9%. So I'm just showing you all the assumptions that are going to get to this stock valuation we're going to do in a minute. And then all the admissions and the concessions are just, let's just look at attendance growth. I've also got at 1.5%. So there are multipliers here, right? Like I said, the box office was growing 8%. Attendance growth was as a comparison to the box office. So AMC's ability to, let's say, grow market share or something like that is only 1.5%. Ticket prices 2%. Food and bev less than 2%. So then that's all of those things combined get you to your admissions and your concessions. And then our other revenue, we'll redo that. Okay, and then sorry guys, I had a little bit of a glitch there, so I'm back. If we look at, where were we? Here we go. I was talking about the other. So if we look at other, and if you just think about how all that Adam has signaled with how fast that's growing, how fast we're going to grow merch, how popcorn is expanding, potentially AMC's ability to even start marketing that a little more and grow that line of business. Basically, I believe our other line is going to grow pretty fast. But if you look at 26 versus 25, why don't we just look at that? Just growing at about 20%. And if you look recently, that is what we've been growing at. Okay, so that's where I think it kind of glitched out on me. I was looking at Q4 24 over the last year, and it was something like 20% growth or something. So I have a feeling we could even beat that number as well. But I've got effectively 2026 growing at 20%. And then if you look at 27 over 26, let's just get ourselves some more. Oops. All right, it's like 13% growth. So nothing radical, especially if you consider the baseline. Adam had shared recently, there was a recent year where merch was practically zero. And so, I mean, you're growing off of a non-existent base. And then now in more recent years, a small base. So you business folks will understand growing on a small base, you could grow a pretty big percent pretty quickly. And then again, with the popcorn expansion and all that stuff. So I think let's watch what we're able to deliver on that. And we will see. These next few quarters are what's going to really tell us where our AMC other line should be. And then, so let's remember I showed you about all the film costs and stuff. So now we don't have to go through these again, but you'll just see versus 25. So if in 25, I had us at about 21.5% on that OPEX. Remember I had the mix of sort of fixed and variable costs for our OPEX. As the box office gets bigger, that's going to drive that as a percent down. So you can see 19.5 and then the 18.3. And actually, just if I told you my gut, I think I'm being too conservative on that. I think we'll be more profitable than that. But I don't want to overhype anybody. The food and bev costs, you can just see I'm just keeping it pretty flat, basically at 19. And then the film costs, I have us staying above 50. Whereas I think, again, go back to what we've been at quarter after quarter after quarter. We've had some lower, we've had some higher, but I think as there starts to be more strength on the exhibitor side, with more movies and not necessarily more screens, maybe there's some more negotiating power. So those costs, I think we've kind of talked about enough. And then let's talk. So rent, I just have increasing 1% a year. Maybe you could argue that should go up faster, but it also depends on, are we really going to increase, decrease properties? Are we renegotiating any rent, any leases? To what extent do those go up? Our depreciation and amortization line, you're seeing I'm actually, why don't we keep increase that? Let's say that CapEx drives more investment and we'll increase it by 2% a year, okay? So you can see that's going up 2% a year. Whoops, that's the wrong line. That's why I'm getting a little bit punchy here because it's been a long video. So I don't want to subtract anymore. Let's say that is going up. Okay, there we go. So I had in the past been taking that down, but let's say based on 2025 as a baseline now, if we have that CapEx, maybe we'll just make that a smaller growth rate. Okay. So now let's go up by 1.5% a year. And I'm being real loose in the farther out years because that starts to be more napkin math. I will dial those in the closer we get. Our other expenses, that again is kind of, I'm making it less. So you'll notice, like look at 2024, or actually here, 2023, it was $70 million in our favor. 2024, now remember we had the settlement I just showed you, it was 156 in our favor. 25 I'm tracking as just a wild forecast, 82 in our favor, and then I'm making it something smaller. Basically I'm just fudging these where I'm just saying let's have less money in those and be less bullish. Our borrowing costs then, I believe we're going to pay down a significant amount of debt, as we expand our run of profits. That the team's just quarter in, quarter out. And I've shown you guys on another, I think it was on the live recently, I showed that it is 14 out of 15 quarters we have paid off debt. So I do not expect the team to stop, especially now that we are significantly profitable. There will be a mix of CapEx and debt payment. And everybody knows I would love to see some investment in Bitcoin, but I will just trust the team. That's their call on that. And I do trust the team and I respect them. So we'll see how that goes. But I'm counting on a significant amount of debt pay down. Why don't we make this less bullish just for our calculations here in a minute? And so we'll just, let's see, there we go. All right, so we'll decrease our borrowing costs by less. And then I'm also thinking, what happens if interest rates start to drive back down? So there's some combination of having paid down debt and interest rates. I'm just continuing on our NCMI payments, right? So that's kind of that 8.9. And then I do believe as we get farther out, Highcroft is going to significantly run, but why don't we make this less bullish? I didn't look at this, sorry guys, before I made the video, so why don't we let's even make this less, just in case there's, I don't know, let's say, okay, so we'll make those more conservative. And you can see I'm just trying to be friendly here and make these up. If I was really publishing what I would kind of, forecast that stamp my name to, but that's not the point today. It's just to show you roughly where we'll be. These are directional. And so I'm fine with that and letting you see some of these I'm just moving around a little bit. And then the income tax, I've increased radically, but why don't we go back and look at total 2019. I mean, man, we were even at a negative level on that. So I think we can reduce these two. Let's just say, I don't know, if we're paying 50 million and, whoops, not minus 50. 50 instead of 60. We'll say 75 instead of 90, something like that. This was just me, again, trying to be conservative and not overhype. But you can see even with those shifts, what I just did these last few minutes is I said our depreciation and amortization is going to get worse. And I said our investment that we're going to make is going to get worse. And I took the borrowing and made that even more conservative and how fast that's going down. I suppose I made taxes a little better to our favor. But now look at this. Bottom line. In 2026, making $460 million of profit. And remember, again, there are non-cash expenses in there, so the cash flow perhaps even better. And then in 2027, making almost $900 million in profit. So now we can finally go. Let us go math that out. So if you've got 433.14 million shares, that is what is showing on most of the chart apps. Let's go take a look and fact check that. But I just looked on Webull. It was showing 433.14 million shares. And if we say, what are our earnings? All right, let's just go over here. What's our bottom line earnings? Okay, so that didn't, it's because By the way, Excel note, if you ever put a dollar sign in front of something, so in fact, watch this. It's called an anchor. Right? So that was anchoring that. Just gonna unanchor those. There we go. Okay, so for those 2 years, that's that profit I just showed you. I mean, it took us, probably, what are we at, like an hour and 20 minutes, an hour and a half or something. And I have told you guys about price to earnings ratios. So if we said we're going to take 20 years of earnings, right? So let's just multiply by this price to earnings. And so we're going to go ahead and anchor that. So we're going to anchor the column B. And then, but we need to divide by how many shares there are. Okay, so this is earnings in millions and shares in millions, so we're kind of apples to apples. And so that would say that, hey, at the end of 2026, which gets, let's say, reported, right? Was that in March? We have our Q1, or sorry, our year-end earnings report, I think in March. Well, I got to go back and double check that. But let's just say March of 27, right? So if we sat around and we waited until March of 27, based on full year earnings of 2026 and a backwards looking price to earnings ratio of 20 years, we'd be at 21 bucks a share. But now so we need to anchor our shares. Let's always look at our shares. And then we always need to look at that top row for our earnings. So that's all I'm doing there is telling those not to move. Okay, but so now just look. Now we're using the 25. We're using our earnings and we're using our shares. I'm just showing you that we're using the right numbers. We're using the 30 and the earnings and the shares. So what I'm just showing you is based on, why don't we just pop in 2027. So we'd say, hey, in March of 28, if I'm at all right about the box office and how, you saw all the assumptions. Let's not go over it all. Every line from the income statement, right? So every line of income and every line of expense, if I was directionally right? So let's just, if we could give this a range. So what if we said, let's go 20% under, and let's go 20% over. Let's give some kind of range. Let's anchor those now. Okay. Why don't we look at our 27s and our 26s? So let's say he is off by a full, this would be huge, 20%. If I'm off by this much, I told you most of the time, oops, nope. I know what I just did. Okay, hang on. So we're going to say this is 80%, right? And this is 120%. I didn't want to write the whole formula the way what it needed to be. I know what we just did. We forgot to lock down that 80. That's F5. And also we forgot to lock down that I'm looking at 2020. No, I don't want to lock that down. Okay. Right? So basically you say retail, you're smoking, we're not going to hit those numbers. I want you to show me what it is 20% below. Come here and actually say, and we could have done this too. Like, let's say I said, no way, film costs are, 52%, right? We go over here, oops, and that would have changed all these numbers, right? Remember this used to be like 21, now that just dropped to 18.55. And so that's why I wanted you to know all the assumptions, because then you can perhaps mess with some of this yourself, but I'm just going to give you some very quick math too on it. So do we have everything locked? B, yeah, we were good there. Why don't we just copy these and see? And this is me being a little rummy again. I'm going to have to see if I did this all. No, I didn't do that right. Okay, hang on. Since I'm tired, long video, and I need some food in me. I think that's what's going on. Okay. So there's our 120%, right? Maybe you say, actually, you weren't bullish enough. The box office is going to grow a lot faster. AMC is going to grow its merch revenue, or there's way more operating leverage. And then, I think we got all those right. let's double check everything. Let's get this right. 20 years, we're dividing by our shares, that earnings number. All right. Okay, so let's take, this is retail's Eric's forecast. Yeah. Then this is our 80% forecast and our 120%. And so when these are reported, what I am telling you is based on, and now remember, if you're a highly growing stock, you tend to get a higher amount of years of price to earnings. And Cinemark was recently. Cinemark was like 31 years pretty recently. I think as of this video, they're a little below that. In fact, hang on, pulling up my phone. I think they're back to being below that. Sorry, scrolling. As I record this video, Cinemark is at 22. But there was a moment recently they were at 31. So, oops, never do that. Okay. So Cinemark is kind of between these two lines, right? But I'm just saying, hey, if I'm at all remotely correct about the full year 2026, then as of March of 27, we're somewhere between $21 and $26 of an old school valuation. And even if you want to say, well, just show me something way more conservative, we're somewhere between $17 and $21, at these price to earnings ratios. But the way AMC would be such a radical turnaround story, and then let's start talking squeeze on top of that. Like what happens if, I'm going to just insert a row here. Let's say the squeeze pushes us up to like, 40 or 50 or whatever. Hopefully I don't, okay. So, and that's not a squeeze number. Let me be super clear. That's not even remotely a squeeze number. I'm not, because of the way I just worded that, let me be very careful not to psyops you, not to FUD you. I am not even remotely saying that looks like a squeeze. It's not what I'm saying. But I'm just saying as shorts are closing, sometimes your price to earnings, can get inflated. And so I'm just showing you even a mildly, I'll call it mildly inflated number, not a squeeze, not a MOAS event, nothing like that. And so all I'm getting at is like, all right, if I waited less than 2 years from now, another year and a half or so, a little more than a year and a half, then if, you're saying if this guy's even remotely right, and he has been in the past, obviously you saw how much I changed on the fly, so perhaps it deserves a little more thought, but because I'm showing you what goes into it, you could make your own assumptions, and so that's why I felt comfortable doing this a little more live. Then you go, well, geez, if I wait until, a year and a half plus, I'm 8x, not 8x, but close to it. What is this? Equals this divided by 356. 7.44x what we were just this close on Friday. And so you can see why I'm so mega bullish and why I can wait. That I know these earnings are coming, even if I'm way wrong. And so let's say, it's way less. I mean, heck, even if you made this 70%, if I wait a year and a half, it's almost 6x. And let's just go a little farther. All right, let's say that there is far more operating leverage and the box office grows and the popcorn expands and we start selling candy, whatever. Just take your bullish item you want. Or maybe I overcounted how much we're paying to the studios and all of that. So, but why don't I stick to that 80 and 20? Just seems more. So I'm just saying we probably, just barely more than a year and a half from now, are somewhere between like $20 and $30 just based on math. Not based on a squeeze, not based on market sentiment, not based on the sort of radical turnaround, just math, just a basic price to earnings math. And then again, like I said, even if I'm wrong, so let's make that range far bigger. We're between 17 and 38, right? You can kind of see why I'm using these two. I'm using our lowest and our highest in a way. Somewhere between $17 and $38 in barely more than a year and a half from now. And that's why I've said too, and I mean this, for some people out there who are just thinking strategically, I mean this obviously with a lot of respect and humility. If there's ever I don't know, discussions on what if there's some really, really big players who start to say, man, AMC's starting to look attractive and the turnaround is really here and I'm not worried about a strike, and they've done it. Because there are people, right, who are big money sometimes is safer money. And so they wait until they really know that the deal is done. AMC is moved to the thrive period, right? You know, us apes, we know it, but if you're going to plunk down big, big, big money, you're a whale, or you're even talking about mergers and acquisitions or whatever, um, you know, they're going to have to think about how to value this. And so I lost my train of thought there, little guys, but I suppose that's why I'm also showing a range here that, you know, someone like that's going to think about a pretty broad range. All of us as apes, oh, that's what it was. So as apes, if we ever get approached and there's some really interesting discussions on the table, gosh, it's going to be hard to think about, you know, it's going to be something well above today's price. Certainly, that's our point of our thesis is we're deeply, deeply undervalued. I'm showing you that based on a price to earnings ratio. Or heck, if we wait 2.5 years, we're somewhere between $30 and $70. I mean, that's a really big range, I realize, but um, it's coming. I mean, look at even in this what I'm calling, I'll call it almost depressed version that I just say I'm way, way wrong, and we're making a lot less money. You know, imagine years where we're making 300 and then $700 million at the bottom line, and our cash is even bigger than that. AMC is about to be printing cash. It is not going to be small what's going to happen. Let's watch, you know, the other thing that I guess you just got to be real careful about in all of this is that CapEx I talked about. As Adam and team ramp that up, that's, I'd like to think I've been careful in some of the expenses here, but, you know, maybe you change that a little bit. I don't know. So screenshot this. Think about, just pull yourself up an income statement. Go back through where I have, you know, shared a lot of the assumptions. Reminder, I'll just go through it again real quick. You know, I'm basically growing AMC's market share by 1.5% in terms of attendance. There's something, whether we're opening up more screens or whether we're gaining market share, there's something happening where we're gaining 1.5% attendance. I'm gaining 2% a year on ticket prices. I'm gaining 1.9% a year on food and beverage spendings. I think AMC can beat all of those, right? So I don't think I'm being overly bullish there. You can see then I'm only growing the other line based on the box office growth, a rate of 10%, and then 6.5%. Okay, so the revenue lines I'm not growing super aggressively. Then remember, I guess the box office we said was 8% growth and then 6.5% growth. You know, what happens if I just, let's type in a number here, right? Let's say 10 billion, I don't know, 700 million, 1, 2, 3. Oops, I missed some zeros. That's the old joke, right? Like, hey, you dropped some zeros. Is it 2 more? 3 more. This is, my stomach is literally growling now. You know, that changes our profit that year to 564 from, I mean, that added 110 million, 106 million, 105 million. That added $105 million at the bottom line, you know, just by adding 400 million at the top, at the box office. And so that also is demonstrating for you that operating leverage that Adam has talked about. It's going to be, and in fact, we would have added more because if the box office grew by that much, I would have come down to this OPEX line and I would have made it even smaller. This percent, I would have changed this. And so we'd make even more money. So you just get the idea that, I mean, in 26 versus all that I just did, if the box office grew by $400 million, if I've under forecast, and there are people talking about whether 2026 could be an all-time box office record, which is certainly a lot bigger than what I'm showing you here. So you can see that I did not drink the Kool-Aid on the box office number. I'm below the industry now on that one. So that's interesting to note. So just regardless, we know that AMC is going to make a lot of money and be worth a lot more. And these PE ratios are absolutely reasonable. Like I've told you before, the S&P 500 historically has been about 19. I'm talking about like a 100-year average. Recently, the S&P 500 has been above 19, quite a bit above. I haven't looked at it for this video. You know, it's probably dropped recently with all the interest rates and various, you know, volatility in the market with all the tariff conversations and different things. But the point is, it's historically, lately, let's say the last 20 years, been well above 20. So if AMC is at a consistent profitability and priced at say more like 25, then, you know, we're talking again a range of from just a year and a half from now, a range of anywhere from 21 to say $40, and then 2.5 years from $40 to $70. So someone coming to make an offer to us is going to have to really think through, you know, I suppose they'll have to argue whether my thesis is over bullish or under bullish. And then also there's a time value of money, right? Like getting an offer today versus somewhere way out in the future. And I don't mean to underscore this offer discussion. Like there's nothing out there. There's no rumors. I have no DD on that. I'm just telling you, I will not be surprised. At some point, someone is going to sniff the value of AMC and either buy a lot of shares, which of course would be a lot of fun for us to see, or be very interested in an ownership stake, like a majority ownership stake or something. So let us just see. That is enough of my voice for you today. The main point is we got a lot of movies coming. We got a lot to be excited about. Let's pull that back up. It's like up, up, and away, right? So come on, what I believe that we will win. So let's go. Oops. Now let's go.